Good morning, everybody. Welcome to today's Cbdc webinar. I'm Jonathan Chiu from the Bank of Canada. Our guest speaker today will be Raphael Auer. Raphael is the head of the BIS Innovation Hub Eurosystem Center, which develops technologies to improve the functioning of the global financial system. Raphael is also serving as the president of the CBRA, Central Bank Research Association. As we all know, Raphael is an expert on cryptocurrencies, stablecoins, and Cbdc. I'm sure many of us are familiar with Raphael's research papers and policy reports on these topics. And today, Raphael will discuss the motives, implications, and research related to Cbdc. The plan is to have a presentation for about 60 minutes, and please post your question in the Q&A box, and I will pose a question and unmute you to ask the questions. And also for the last 50 minutes, we can use it for more open, informal Q&A. Without further delay, let's welcome Raphael.
Hey, thanks a lot, Jonathan, for the kind introduction, and also a lot for Fahad and Will for the invitation today. It's very exciting to be here. I always get the invitations, and obviously I'm right as a central banker. I'm working on the very central part of the decentralization spectrum, but I have a great interest in all aspects and feel that with work on Cbdc advancing, with central banks getting very interested in programmability, and with sort of the continued rise of the DeFi ecosystem, and a lot of hype, a lot of disappointments, but key innovations here and then, like Uniswap. Eventually these things are gonna converge, and we're gonna see some very radical change, and so it's a great honor to present here today. What I'll present, having said that, as a researcher, as president of the Central Bank Research Association, I have a very broad spectrum. In my old role, I was sort of the policy lead for anything Cbdc. I worked, on many policy reports, many speeches, and many sort of light, high-level research papers, and on Cbdc, and that's what I'm going to present about. I'm really going to be presenting an overview piece. It is in the forthcoming in the annual review of economics, and it's sort of what we do is we give really a guided tour of the literature from a policy perspective and deriving open research questions from it. Let me share my screen. So the title is Cbdc Motives, Economic Implications in the Research Frontier. It's with John Frost, Leonardo Gambacota, Cyril Monet, and Tara Rice, and Hyun-Chang Shin. And as always, when I'm presenting, I'm speaking about my own views and not those of the BS. And as I just said, sort of, we really want to give. Before I start, actually, please. We already have a question. Always feel free to post questions in the Q&A box, and then maybe Jonathan, you can bring them up at sort of the right point in time. So, for example, now we have one. I think I'll answer it a bit later. Why do some central banks sort of how we share technology? But I think this is for a bit later. So let me get back to the presentation. So again, always feel free to post questions, and Jonathan will just read them out at the right point in time. We do not need to wait for a larger discussion at the end. So right, and sort of a bit of the starting thought of this paper was that, especially when you look at early research on Cbdc in academia, there was really a very strong focus on this reserves for all aspect, so the balance sheet implications. How much larger would it make the balance sheet of the central bank? How much would it make it more difficult for commercial banks to raise funding? And how would this look in calm time and during market turmoil? But instead, sort of, and that was certainly very much the flavor of a policy discussion in 2018. You can see it. There was one joint report by the CPMI, the Committee for Payments and Markets Infrastructure, and the Markets Committee. So together, let's say those are the top 30 central banks of the world. In 2018, it was very cautious and it was very focused on these questions. But then the sort of the policy discussion really moved on faster towards different questions, and they were focused mostly about the use cases, technical questions, that sort of, where we said actually CBDC should be really considered in the context of the digital economy and the centrality of data. How will CBDC affect competition, the integrity of this payment system, and privacy? And we sort of circled in on designs that actually limit the impact on financial stability and monetary policy, because sort of that's not the goal, right? The goal is to do something in the payment system. The goal is not to offer savings accounts. And then we also thought that at the cross-border, there was a lot of policy interest. There is a G20 agenda to improve cross-border payments, and there is comparatively little research on this. So this is sort of the starting motivation to sort of highlight what the policy considerations are, to open the field for academic research a bit. And obviously there is something. So with that context, let me actually start with the history of CBDCs and then go to a stock take. So when we talk about CBDC, we can start with the money flower. What is a CBDC? And at the very highest level, it's a central bank issued digital currency. It's certainly electronic, and it has some degree of tokenization, some degree of peer-to-peer exchangeability. If it's universally accessible, so for households and the general public, it's a retail CBDC. And otherwise, if it's only for the regulated financial industry, it's a wholesale CBDC. I'm going to be speaking mostly about retail CBDCs. And here, right, it's very important to define them properly as a concept, not as a technology. A retail CBDC is just the concept to make a digital claim on the central bank available to households and the general public in electronic form. It's this concept and nothing more. It doesn't depend on any implementation. Right? So and this is why it's a third type of money. Today we have cash. It's a direct claim on the central bank. It's not a claim on an intermediary, and it's physical. You can exchange it in peer-to-peer settings. And then you have any form of electronic money that is always a claim on an intermediary. There might be some backing up of that claim by reserves in the central bank, but still the claim is always to the intermediary, and the intermediary might have solvency issues, might have liquidity issues, or it might be fraudulent or have other issues. And so retail CBDC is really just this concept, this third type of central bank money, right? Because that's what a claim on the central bank is. It's central bank money.
Raphael, can I ask a question here?
Yeah.
So you emphasize this nature of direct claim of the central bank. Does it mean that it may rule out, what the people call synthetic CBDC by this definition? And if so, why?
Yes. So there is this concept. I will come back to this. I have a slide on this. And sort of there is a joint report, including the Bank of Canada and including the BIS, including the Fed, the ECB, that explicitly makes this statement, right? That a synthetic CBDC, some designs that do not feature a direct claim on their central bank, are not a CBDC. They may be good designs. That's not the issue. But per definition, they're not central bank issued digital currency because there is no claim on the central bank. And I'll come back to this in the context of operational setup. It's a very interesting question. When we think about developments, you know, here's a little plot of the timelines. And actually, we could start a bit earlier. We could start in the early 90s in Finland, where the Finnish issued something that actually I think makes a lot of sense is the Avant card. It's a prepaid value card operated by the government that allows for some offline and online payments. And it was in use. I think there were a few 100,000 cards outstanding for a few years, but then sort of it got superseded by the widespread use of debit cards issued by commercial banks. And it's not a CBDC per definition, because actually it's the Bank of Finland structured in a way that they set up a subsidiary and the claim was on that. So actually, this is not a CBDC, but you know, given that it's within, you know, it's a subsidiary 100% owned by the central bank, you could say it almost is one, because they would surely have recapitalized it had it had run into any problem. But we see then later, right, there are some developments. There is a trial in Ecuador that actually was discontinued due to low demand a few years later. So we should keep in mind that not everything was a success. And then really in 2016, 2017, we see speeches, we see pilots, we see research reports, and at the end so at the start of 2020, we even on this chart that doesn't include every country in the world, we see a first pilot. So underlying, you know, there was also a very big shift in central bank communication on this issue. This graph looks in. Yes,
just
please.
A quick question about the definition in the Q&A. It's about whether or not under this definition, the wholesale CBDC is different from central bank reserves that we currently know.
Yes, so the definition, the difference between a wholesale CBDC and today's accounts that commercial banks have with the central bank is a pretty vague one, right? Because also wholesale CBDC is a claim of a financial intermediary on the central bank, and it's sort of the difference is in the underlying technology and how this is made available. Does it allow for programmability? Does it include some degree of tokenization? But when you look, you know, you could say it's really, you know, it's a definition question. I think as soon as you sort of start introducing some conditionality into today's bank reserve accounts, then you have what you could consider a wholesale CBDC. I think that's right there. It's a technical distinction, because banks always had access to the central bank balance sheet in electronic form. Jonathan, you keep track of the questions when the right moment comes to raise them. I'll go back to going through my slides. So at the BS we have a repository of all central bank speeches. It's a very good repository for any kind of research on central banks, by the way. And here, so this includes like 17,000 speeches, I think, as of now. And here we looked into any that included the keywords digital currencies, CBDC, and so forth. And then so those are speeches made by governing board members of central banks. And we looked into whether they took a positive or a negative stance on issuance. We also split this up by retail and wholesale. And we see that actually, so central banks start talking about this around like just after the first cryptocurrency bubble here, right? So where we saw this spike in valuations and then a collapse afterwards. And we see that sort of there is talk on retail CBDC, but it's pretty negative. Later, we see there is then some more positive stance later in the year, right, 2018, but not much. And so this flattens out. And when it really changes or starts to change is in later 2019, and that's around the Project Libra announcement, where you could really see that sort of suddenly the public discourse changed, right? And people said, well, central banks should look into CBDC, and where before everybody had been quite negative. And so that changed the tone, and we move into slightly positive territory. And certainly we move into positive territory maybe in January, but we get a substantial kick thereafter with the COVID pandemic and the changes in the payment behavior. And from then on, right, speeches have been vastly positive on either retail or wholesale CBDC, and that is still ongoing. And so this is just, there is a massive change in our payment behavior, and it crowds out central banks' oldest product. And of course, central banks are now looking into coming up with a digital complement. And along with talking about this complement, and that is sort of the net stance, is this black line that I'm again displaying here. Also, we've seen more and more experimentation. We've seen some early experimentation in some central banks. I showed you there were even earlier ones here, right? We had a couple of ECB, Bank of Canada, Bank of Japan reports. And then sort of we really see sort of this steady increase, but again, the pace is just increasing in late 2019 and with the pandemic. And now, right, we have, I guess it might be 100 projects, but this is because some countries have more than one, right? They have both a retail and a wholesale project. And what we also see is that nowadays, this is the vast majority is retail. Early on, a third was wholesale. So the focus has simply shifted towards retail. But of course, this is consistent with the COVID pandemic changing retail payment behavior, and it didn't really change wholesale payment behavior. If we look at this, the state of where we are, this is the map as of today. We have 3 live CBDCs: Bahamas Sand Dollar, ECCB's Dcash, and Nigeria's eNaira. Should be cognizant that the ECCB's Dcash had a 1-month outage. So, that's a warning sign as to how fast you want to roll out things. And we also have pilots, and obviously we have a very large pilot in China with supposedly 200 million people having used the system already. So in many countries that would be a very big live CBDC, but in China it's still a pilot. And research and development throughout the world. What is important when you look at this map, and there are some other maps, is that this information is really the official stance. So what we do, and that's for any of the data I'm going to show you, and all that data is updated every quarter. It's this working paper, The Rise of the CBDCs, BIS working paper 880, and in the webpage you can also find the quarterly updates. Is that we look at only at official central bank communication. So a report, and sometimes it's a tweet, but it's a tweet that comes from the central bank. And we look into designs, and when there are questions, we actually get in touch with the experts of the representatives of the respective central banks. So this is really, vetted information, and we do not include rumors, and we do not include where somebody says this is a CBDC, then we get in touch and we say, what is the structure of the claims, what is it that you do? And then sometimes we say, no, this is not a CBDC, we can't include it in our stock take. And this is really because we really are interested in what central banks are actually doing, and is this really a CBDC? And later I'll show you what type of CBDC there is. So, but sort of that includes my stock take of what central banks are doing. And I want to go a bit deeper into why they are doing it. And I'm going to take 2 stabs at this. The first one is from the survey of the CPMI. There is an annual survey that the CPMI is doing. It used to ask 65 central banks. Now it's asking 80 central banks. If you were to issue a CBDC, what would be your main motivation? And then we see that here we have it split up by advanced economies and emerging market economies. That that sort of one thing that features really high is payment robustness and safety and safety, and that sort of holds true for both advanced and emerging market economies. And in emerging market economies, there is a second very broad set of criteria, and that's sort of the efficiency, or that's costs, and inclusion, which doesn't feature in advanced economy at all. So you can clearly see that advanced economies have much more a resilience motivation, whereas emerging economies have more a low-cost, accessible payment option perspective. On the wholesale side, there is no clear patterns because, right, in the end, you're going to address some possibilities for your financial industry with it. What I just showed you is a survey, and obviously any survey you have to ask yourself, you're asking maybe central banks that have no intention to issue a CBDC or that are very early stages about their motivations, and they might not have thought about them actually in depth. Another a bit harder criterion is to look into revealed policy preferences. So if we actually look into those central banks that are really doing something, what are sort of the national characteristics of these countries? That also gives us an idea of what the motivation behind the also what the drivers of CBDC trials are. And what we do is we go back to sort of the stock take of CBDCs I showed you before. We do a project index. We say a country gets a score of 0 if it hasn't not announced a project, 1 if it says it's doing research, 2 if there's a pilot, and 3 if there's a live CBDC. We also do this for retail and wholesale. The overall score is the max of the retail and wholesale index. And
Raphael, before you continue, maybe it's a good time to take a couple of questions.
Certainly.
First of all, I think Will has a question about the motivation, whether or not, right? So, kind of the related to competition among central banks in terms of a first mover advantage, whether or not that seems to be not considered in the motivation. Is that something that it is discussed?
So no, in the international context, sort of the first mover advantage is not really something that I see discussed much. What I see more is sort of in the cross-border dimension, the need to coordinate standards, right? You don't want country A set up a system in one way and country B set up a system in another way. But on a first mover advantage, I don't really sort of at the current state, right? They're sort of most systems are still experimental, and no standards are being sort of set in place. And also, we should keep in mind, right, that we just have transitioned or are still in the last leg of transitioning to a new financial standards, ISO 20022, and that should, be the standard that everybody could build on, or some variant, maybe allowing for more functions. But there are standard setting bodies, and so yeah, I do not see many discussions around first mover advantage.
I see. Another question I think I believe that probably you will cover a bit later is about whether or not the optimal CBDC type may depend on the jurisdiction or the country-specific factors.
Yes, certainly, right? And we've already seen that there are different motivations, and then that explains, I think, why people choose very different options. And I'll go through this because we have a stock type of what kind of architectures, how they think about access, and then I will answer it sort of going through these slides. But it's a very relevant question.
Thank you.
Let me go back to the slides. Let me just show you just one table of regressions. Obviously, there's much more, but let me give you the gist of it. So we want to look at what are the cross-country correlates of being active in the CBDC domain overall, being active on retail CBDC projects, and being active on wholesale projects. And the overall picture is that it seems that if countries that are either scoring high on innovation scores or that have high level of digitization are developing digital currencies, and that at the retail front, this picture emerges too, but also we see that countries with a high share of the informal economy are looking into CBDCs, into retail CBDCs. So maybe also the motive of of formalizing informal activity via a new payment rail could feature in development efforts. What we do not find, surprisingly, and here this is for trade openness, but I could show it for remittance flows even, or for other variables of sort of the international variables, we see absolutely no correlation. Here it's even slightly negative for retail, for wholesale it's insignificant, with measures of international activity. So it seems that at this stage, the motivation of CBDC design has to do with domestic factors. And last, for wholesale CBDC, we see a strong association between financial development index and development efforts. And again, that makes sense, right? You'd expect to have countries with an advanced financial system to look into novel developments first. So right, everything intuitive, but still also gives us an indication of what the revealed motivations are if you look in this cross-country dimension. And a survey and a reveal analysis are two different sides of a coin, and together sort of I think they paint a consistent picture. Let me now go into sort of the considerations, and let me actually really start with the microeconomic considerations. What is the operational setup? What is the technology? And what is the privacy? And we've sort of at the BS come up with sort of a design thinking framework for CBDC design, and that is a user-centric one. If you had decided to sort of develop a retail CBDC, what would you why would you do it? Well, you would want to address certain consumer needs. You would want to have a useful product. And there is a couple of sort of layers of needs, right, that comes from psychology, also in payments. And these lead to sort of some trade-offs on the technical design, because some needs conflict with others in what they desire from the technical design or the policy design. And the first layer, and I'm going to go into much detail, I'm also going to go back to the concept of synthetic CBDC in that context, is the architecture. And here, right, if I think about sort of the role of the private and the public sector, there is a bit of a trade-off that on the one side, right, we start with the notion to introduce a cash-like direct claim, and we also, aside from the legal claim, we also want to have this sort of peer-to-peer functionality that doesn't involve middlemen. That's one need. On the other side, if we think about payment systems, we need to be cognizant that intermediaries, private sector intermediaries, involve a great set of convenience to the payment system. It would be very hard for a central bank to introduce contactless payment or smartphone-based payments, right, in a manner that the big techs can do. And we should also be aware that in payments often work for consumer even if there is no connectivity, because there is some risk taking in the payment system. We can all experience that if we pay in an airplane. There's certainly no connectivity, but the sort of the payment terminal just stores the information and then checks it once the plane has landed. And of course, this risk taking is acceptable and it's actually the airline that's on the hook. because, right, they can very well identify you and even, maybe, come to your seat if they land and they see there's a problem. But there's sort of this risk-taking flavor also, at the millisecond level in day-to-day payment systems. And it's not clear, right? This always relates to know your customer. And it's not clear that sort of the central bank could perform these functions because it just, it's not an institution set up to do all this. And that really brings to the fore sort of this discussion on the architecture. A second thing is, and I'm going to go through what kind of operational setups are feasible in a second. The second thing is that, if you know conceptually how you want your payment system to look, the central bank needs to think about what kind of architecture it wants to operate. It needs to be robust and resilient. Robustness meaning it doesn't break down often, and resilient meaning if it breaks down, there is a way to restart it. That's a big thing because if let's say Visa has an outage and the payment system is restarted suddenly, Visa gets millions of payment instructions, many of them duplicates because people obviously keep swiping, and you need to have ways to sort that out. And obviously there's a number of technological trade-offs here, but in this stock take, we focused on whether you use a centralized or a convention or a DLT-based infrastructure at the central bank level. The third layer is sort of, now you know sort of what your product is, but you need to think about how you give access to the user, and the user would want it to be very accessible, like cash. You can give coins and bills to your kids, and they can handle it, right? There is no identity check. It's just usable, and it's also private, right? And you kind of want to offer these features in a CBDC-based payment system, but at the other side, electronic money payment systems scale rapidly and could lead to abuse, and so you want to ensure privacy in lawful exchange, and you need to think about how you give access, and here we follow Charles terminology to give account, so that means identified access or token-based access. I understand that some people don't like this terminology. You can think about it as, do you require full identification, or do you allow for some type of privacy and identification via information? And last, you want to think about use cases that go beyond your border. How do you facilitate cross-border e-commerce in your jurisdiction? How do you think about usage abroad? And you need to think about interlinking the CBDC-based payment system with your domestic infrastructure, how that links abroad. And also, you need to think from a policy perspective. If, for example, I'm in Switzerland, I have a souvenir shop in Lucerne where I have a lot of Chinese customers. Should it be feasible that these customers pay with the EU one? And that's a policy choice for both the Swiss and the Chinese authorities. And these new possibilities have to be taken into account. So let me actually start with the bottom layer of the pyramid, and sort of with designs, because I think that's really the quintessential thing. How does a CBDC look like from a concept of who does what and how much does the central bank do? Now, I started earlier that the legal claim has to be on the central bank, otherwise it's not central bank money. And the sort of then the first notion is that the data flow has to be aligned with the ownership structure, and the central bank would have to do it all, right? It would have to do the KYC, onboarding, outsourcing due diligence. Now, maybe you could even outsource that, but a central element would be that the central bank, has a full ledger of the transaction, and only once a payment makes it through to the settlement to the server of the central bank and then back to the confirmation to the user interface, a payment sort of has occurred. And then, of course, we not only run into sort of these like what are the types of activities that a central bank should engage in, but we also run into, you know, outages of the payment system and whether the central bank is well suited to deal with all of them. And the answers that most jurisdictions give you is, well, no, the central bank shouldn't be setting up any CBDC-based payment system in that way. Rather, what we should think about is separating ownership structure from data flows. And that is actually seems strange a bit at first sight, because so you owe funds to people, but you don't know to whom. But then we think about cash, and that's exactly what cash is, right? The central bank knows it has certain amount of cash outstanding, certain, you know, serial numbers, certain numbers of different banknotes of denominations, but it doesn't know who owns what until somebody actually shows up and says, yeah, I own this much you know, of dollars because I hold a $20 bill. And with CBDC you structure it similarly. Obviously, it's a digital payment system. It needs some record keeping, and this record keeping could be provided by some private sector payment providers who have the retail ledger. And then one design option is, we call it the intermediated model, is to pass only sort of the aggregate information onto the central bank. That means here, so here the graph displays only one PSP, but there could be many, and each of them just says, well, today my customers own $400 million, and in the net they've transferred, you know, 46 to these other PSPs. And that's a system that will work. For the central bank operationally, we need to keep in mind that would actually be the exact same thing as it does today. Right? It would basically operate a wholesale ledger, and that's exactly what it does today. But there would be sort of issues that are also similar to today. Is the sum that each payment service provider reports to me, is that actually correct, or is there fraud? There are some cryptographic techniques where you can credibly say, on the one side I have 1,000 consumers, and on the other side I'm not telling you how much each of them has or who they are, but I'm credibly telling you that together they own $400 million. But that has, you know, those are novel cryptographic techniques, and they're not mature. They might have security issues, and they're very, very slow, far too slow for a payment system. So then that means you would have to do supervision, and you would end up with a set of policy questions that very similar to what you have today. So central banks have also been looking into other designs, and we've called that the hybrid model because it runs on two engines: a ledger run by the default ledger run by the private sector, and a backup ledger run by the central bank. And here, you have the same thing that the PSP do the onboarding, do the record keeping, but they pass on some information to the central bank. Could be periodically. That's actually a computationally much easier thing than to do that in real time. And that makes the operational setup for the central bank much different. It's a huge difference to periodically receive a consolidated ledger or to do live transactions. The sort of what you would gain is that sort of this supervision function could be much simplified, because sort of the way you can credibly check this data is from arrangement, a cryptographic arrangement, much simpler in this way. And second, you would have resilience options. Could be many, but so for example, one idea is just if one PSP has an outage, but another PSP works, you just take these client relations and transfer them to the working PSP, and you can do that because you have all the information, right? You know, this user owns that much, please credit him. And so, you know, there are additional options in that.
Raphael,
In terms of these,
there's a question related to the setup, also the direct claim from Francisco. He's asking kind of a behavioral question. So in all this model, how do we ensure that users know that the claim is really a direct claim with the central bank? It's kind of from a behavioral point of view.
No, I think that's a good point, right? Because much of the debate of CBDC, and Francisco knows that all too well, is also right that central banks have this visible product out there. That's a great product, and we're one of the very few public sector institutions that actually almost every day people use our product, and you know, everybody really wants it, and it's hard to let go of it. So this kind of this anchoring of the unit of account is something that people emphasize, and I think, you know, that's again, you know, where cryptographic techniques come in, that sort of make, even though if the PSP does some functions, it's not that the PSP could ever steal your funds, right? It would just technically not have that possibility because you keep certain keys, and that makes the system a bit more difficult for the user to handle. But you could have the same assurance as you have with a banknote, which also isn't always forgery proof. It actually, if you want that, right, you need some equipment, you need to put some effort to verify it, and I think sort of this flavor could be carried over to a CBDC, and I think it's a great practical question to look into, and I'm now thinking that the Bank of Canada is doing just that, although I don't know.
And
But
also, Sigua has a question about whether or not China's eCNY is considered hybrid in your classification.
yes, it's hybrid. It's the quintessential hybrid model. There is sort of a nuance to the hybrid deviation in the sense of, and that actually you have also in the initial Rix-Krona proof of concept. I'm not sure in the current pilot how that is solved. I haven't read that, but there is sort of, right. So the PBC said it has the ledger of all transactions. It doesn't necessarily have like the full information on the people. So with a grade 1 wallet, they have 4 types of wallets, and with increasing limits of how much you can transact and how much you can store. With a type 1 wallet, you get it via a cell phone. Now in China, that's also already a very good identified concept. If you have a cell phone, somebody has identified you. But the PBC doesn't know who you are; it just knows the number, and there could be a legal process initiated by someone to sort of combine the cell phone number with the rest of your identity. So there is a nuance to it, but the PBC gets a backup copy of the entire ledger of transactions. And in the Riksbank initial pilot, that was a similar setup where the Riksbank has the full ledger on a fully anonymized basis, and there are these onboarding intermediaries that do the KYC, and then they say, well, pseudonym X has 40,000 kroners, but the Riksbank doesn't know who pseudonym X is, right? All these sort of the privacy and also the ensuing legal issues are sort of outsourced to these onboarding firms, and that's a very good design. But generally, you know, right, this goes already back to this sort of the trade-offs that you have here, and it's about the role of the private and the public sector. Obviously, in the direct model, there's no private sector. It's a fully central bank operated payment system. In the hybrid, it's you know, it's more balanced, and intermediated, it's more like it is today. What are central banks? Yeah, coming back to Jonathan's question. An alternative to CBDC, and this has been floated as the name of synthetic CBDC some years back, but then sort of central banks made a point that this should not be called CBDC because you do not end up holding central bank money. We call it the indirect architecture. It's not as sexy as synthetic CBDC, but that's what it really is, right? It is sort of a narrow bank where private CBDC banks, they sort of issue claims, and the only thing where the CBDC really features is on their asset side. They back up each claim on that the consumers have with them fully with CBDC holdings that sort of are a claim on the central bank. So that system obviously has very good safety properties, but there are still intermediaries who who have balance sheet risks, and the consumer does not end up holding central bank money, so it's not a CBDC. In terms of what central banks are actually pursuing, so again I go back to our stock take, and we look into these reports and we try to identify how can we sort of fit this description in this scheme. I have to be open, right? It's a difficult task because the descriptions are all over the place. Nowadays, they're sort of becoming more standardized, but especially when we started, people were describing, just the notion of how this could look, and without specific attention to detail. So again, we get in touch with all the central banks and we say, where would you most see your designs? And many are still simply undecided. Of those that are decided, the vast majority are these two-tier versions that involve a substantial role for the central bank. And there is a few direct ones, and that is simply remote areas, maybe island groups, where the answer is, well, there is no there's no private sector that does it, nor do we see any private sector activity going to enter it in the foreseeable future. The only option is for us to do it, and so we're going for the direct design. There are also some jurisdictions that are in principle open to multiple designs. So for example, the Bank of Canada in 2020 said if we were to issue a CBDC, and there was a contingency analysis back then, then our major rail would be a two-tier design, but there could even be the option, if the two-tier design then doesn't reach the whole population, maybe some regions or some social segments of the society are left out, then it could be considered that in line with public policy goals, a direct option would be like a small scale sub option of the CBDC based payment system. So we can see a variety of settings, but we can see a very clear tendencies to the hybrid or intermediate designs with a strong role for the public sector. To complete the stock take, right, the CBDC pyramid had 4 layers. We've gone through architecture. We go now, let's talk about technology, how you get access and how it interlinks. And the complete stock take, and that's as of January 2022, is as follows. So we, in terms of what kind of infrastructure, again, it's always the modal answer is we don't know yet. But of those central banks that have decided, we see conventional and DLT on equal footing. We see actually many pursuing all options. And I think what is important to point out here is that there is a trend towards conventional designs. Quite frankly, the reason is that early CBDC trials were simply motivated by the fact, well, there is Bitcoin, people are really interested in. Can a technology of this sort, not proof of work, but some distributed ledger technology, be put to good use in a central bank digital currency? And then after some trials in many instances, the answer is, well, we start with a C in the name. Is there really a case to put a D in the technology, right? Because it's not that a conventional technology does not have very good resilience and robustness properties. It's stored in multiple places, it's distributed, but it's not in terms of the computing, but it's not distributed in terms of the trust concept. But you start with trusting a central entity anyway, so you might as well end up there also on the technology base. But it's not clear where we'll end up. We could have multiple designs. On the access, again here, token means fully private, account means fully identified. And what we see is that full identification is in the lead now. That is also a trend. People were more open to fully anonymous systems early on, But one important trend, and I think that's really where developments are headed, and it makes also a lot of sense, is to have a tiered system where you get anonymity, or at least very good privacy, for low value payments, and then as the sort of the volumes and the balances go up, you need to have stronger and stronger identification criteria. Let me note that this is sort of conceptually a very good, easy idea, but it's quite challenging to actually to commit to the full anonymity in these tiered systems, and I haven't seen a really convincing approach yet that is like really like at the scale of a payment system could offer these properties as we describe them in sort of our policy ambition. Last interlinkages. Here it's very simple. Is the focus domestic or is it international? And the sort of now it's again on even par, but again very strong trend here in the initial stock take in August 2020. It was almost exclusively national focused, and this has really shifted also with sort of the G20 endeavor to improve cross-border payments, and one part of this whole work stream being the work on cross-border CBDC, on multi-CBDC arrangements, and on fostering an aspect of interoperability in CBDC payment systems from the get-go.
So Raphael, before
second,
you continue,
yes,
there's one question about another kind of design choice, which is about fungibility of between CBDC and bank deposit, and maybe also with cash. And is it kind of now a consensus that central banks want to maintain this fungibility or convertibility, and so that it is not really incorporated in these design choices here?
Yes, thanks. It's a very good point, and I think I want to reverse it. It's like anything that's not convertible is not going to be a successful CBDC. It might be a new type of savings vehicle, right? Because for savings, you can sort of accept some sort of illiquidity, but any payment service provider will tell you if you start having exchange rates between various payment means, you do not have a coherent payment system. So it has to be fully consistent at any time of the day, 24/7, 365. And anything else is a non-starter. So that sort of concludes the microeconomic aspects. This is really important. I also want to go back right now. We will be talking a bit about implications for banks, financial stability, and monetary policy. And I also want to emphasize this operational design is very important for the financial industry, because if you think about how banks make money, a lot has to do with the franchise value, with the customer relationship, with know your customer, not for law enforcement reasons, but for trust in how much credit can I give that customer, and with these operational designs that involve the private sector, you would still have that, right? So banks would have an incentive to offer these CBDC wallets because that's the way they get the franchise value. Actually, you see that in China, where the motivation for a CBDC was also to sort of tackle a duopoly in retail payments, where two big techs had 94% of the market, and the CBDC gave sort of banks a door back into that market segment, and they were super supportive of that project. And that, I think, is a general consideration that sort of in sort of the how a CBDC would affect the private financial system. We shouldn't be too concerned about the balance sheet effects, but we should really be thinking about these, the microeconomics of business and how a CBDC introduction will affect that. And actually, So I want to talk about this slide, but I've also reached out to Jonathan because he was asked to be the host today, but he has a very good paper, and he's actually then going to talk about this paper for a few minutes, and he will do it much better than me. I just want to give you sort of the sum up of why central banks are not so concerned about these aspects at the large, and that is, we know that a direct claim-based payment system on the central bank can work very well with a fully functional, fully funded commercial banking system where people deposit the vast majority of their funds, because that's already exists. We have cash, we have commercial bank deposits, and around the world, people deposit around 10 times as much in commercial bank deposits than they hold in cash. So in the US and UK and Euro area, it's more like $4,000, $5,000 or euros in cash, and 10 times that in commercial bank deposits. And with Cbdc, you can do that. You can sort of make it attractive as a payment means and unattractive as a store of value. You could do it via interest rate differentiation, or you could do it via some tiering caps. I mean, obviously, a hard cap won't work because if somebody's at the cap, they couldn't accept incoming payments. So then you'd have a broken payment system. But sort of, you could have different designs where you have tiering of the interest rate. Ulrich Binzel has proposed that, if you are above the cap, then sort of the interest rate becomes rather unattractive, and that makes you shift your money out. Or you could actually axiomatically have this waterfall approach that is adopted in the Bahamas Sand Dollar, where everything in excess of $2,000 of holding is automatically transferred to a linked commercial bank deposit. So here's the point. You do not need to be concerned about the systemic impact as a policymaker, because you can control that pretty well, right? You want to actually, I think you have to think about adoption and what sort of the use case is. But there are some interesting thoughts still. Even if sort of we do not want the total amount to be very large, could it still affect competition? Could it make the payment system much better? And I have some slides, but then I really thought, no, it should be Jonathan talking about this. So let me actually unshare for some seconds, and maybe you can put up your slides, and then we can have a discussion, or I can come back to my slides. We can talk about the international dimension or privacy. We'll see.
They're happy to do that. Can you see my slides?
Yes, we see them.
Okay, so I just quickly talk about this topic about Cbdc and bank disintermediation issue that we study in our paper. So basically, the concern is that the literature focuses on the disintermediation concern, which means that by competing with bank deposit, right, Cbdc could raise banks' funding costs. As a result, banks may reduce the scale of this deposit and potentially the credit creations, right? And this argument can be represented by this simple kind of supply-demand diagram, where the upward sloping supply curve is the depositor supply of deposit funding. The demand curve is the bank's demand for deposit, and that here you consider kind of a simple, perfectly competitive market. Bank introduces Cbdc. So in this diagram, let's say if the central bank introduces Cbdc with an interest rate at our Cbdc this level, what it happens is that basically it will, when it's sufficiently high, it will be forcing banks, right, to raise the deposit rate in order to maintain their clients, right, to retain their clients. So effectively, this becomes an interest rate floor, right? And in this case, when in a perfectly competitive market, this will basically lead to a movement, right, along the demand curve and leading to lower deposit quantities and a higher rate. So this is basically how Cbdc could potentially, right, lead to a disintermediation. And this is kind of the concept that captured in a simple version of the Kister-Sanchez paper. Now, however, this argument may not hold, right, when banks have market power. right? Here you consider a case where the deposit market is imperfectly competitive. And as we know, in this case, right, banks will offer deposit rate that would be lower than the competitive level. As a result, right, the equilibrium deposit will be lower also than the competitive level, and the loan quantity will also be lower. So here we implicitly assume that the loan market is perfectly competitive, so that it can also be captured, right, in this diagram, where the loan rate would be captured by the demand curve, so that the banks are basically earning interest rate spread given by this difference between the loan rate and the deposit rate. So again, what will happen now in this when banks have market power, when Cbdc is introduced, right? So again, the Cbdc will set an interest rate floor for bank deposits, right, and forces banks to follow to raise the terms. And in this case, this will indeed lead to a movement kind of along the supply curve. And when banks, right, offer higher rate, that could attract more deposits, right, into the banks. So with this extra funding, what can the banks do with it, right? There are different ways. One way is maybe they could choose to lend it out, right, since they are still earning a positive margin. So if they lend it out, then it will lead to more loans and a lower lending rates. Overall, in this case, right, the introduction of a Cbdc could, instead of crowding out banking, it could sometimes, right, crowd in banking, right, in the sense that there would be more deposit, more loans, higher deposit rate, lower lending rate. So it seems like everyone will benefit from it, but only the only loser in this setting will be banks, because that they are losing profit. So this is kind of the idea that's captured in Andofado's paper and my own work with my co-authors at the Bank of Canada. And so far, we're considering a Cbdc that pays interest, right? But many central banks do not plan to do so, right? So indeed, in our paper, we show that even when the Cbdc is non-interest bearing, it could potentially still promote bank intermediation if the use of cash is declining over time. So the idea is that when the economy is becoming increasingly cashless, banks would gain extra market power, and eventually they may decide to, offer a negative interest rate or charging higher fees on deposit. So at some point, right, so a zero interest floor introduced by Cbdc could become effective, and that again the whole logic will apply. So this is basically a quick summary of our paper, and then the main takeaways here is the following, right? So first of all, the market structure matters, right? So when banks have market power, CbdCs does not necessarily crowd out private banking. And indeed, with an appropriate interest rate, it might even crowd in banking. And what is interesting is that in this case, CbdC may not have a significant market share, because what it is doing indeed is just providing outside option, right? That can enhance the bargaining power of depositors. And we also show that, as I mentioned, right, even a non-interest-bearing Cbdc could play a role when the economy is going increasingly cashless. So overall, it says that, well, depending on the market structure, disintermediation may not be a big concern. Now, but does it mean that a central bank should issue a Cbdc because of this potentially positive impact on bank competition? My take is not necessarily, because this is just one potential benefit of Cbdc, but there's also, we need to consider the cost side of building a Cbdc, and also there are alternative policies that can also promote competition, such as regulations. Okay, so yeah, so this is a quick summary of our research. Thank you.
Great. Thanks a lot for supporting my talk here. In the meantime, I read that we have two new questions, and let me sort of read them out and then answer them. So one is on, if bank deposits and Cbdc can be used for your payments and they always need to be convertible, how can the central bank control the money supply? So, again, you need to ensure convertibility, but you could apply in the stock, right? You could apply a very unfavorable interest rate, and via that make the CBDC less attractive or more attractive, and you could always have a good handle. It is true, right? If you have hard caps, then you run into convertibility issues, and that's, I think, why they are a non-starter. But in principle, right, I can have full convertibility, but once you're in the CBDC, I'm gonna it's gonna be very unfavorable interest rate, and that's gonna get the money flowing back into the private commercial system. A second question is, if the CBDC is based on DLT, this requires a lot of computing and energy too. Could this be a concern? And I think sort of I didn't mention it, but I think we obviously need to be aware that there is permissioned distributed ledger technology and there's permissionless distributed ledger technology that could run on proof of work or proof of stake. And central banks are only looking into permissioned variants. So those are network of validators that jointly update a ledger. Principally, if you look into proof of work, this is very costly. And again, you start with a centralized system, you start with trust in institutions. There's just no justification to add these extra expenses. Could it be done with proof of stake? I think, sort of in theory, yes. In practice, these are just systems that are, have lots of caveats in how they can be jammed or how they work and at what speed they work. So I do not think that will be the case, because again, you can have these permission variants. You are in an environment where you trust institutions, and then that just seems the more straightforward way to go. So we are sort of in the time where we have a discussions. That would be good to have more. Otherwise, I'm also happy to talk a bit about the cross-border dimensions, which is where the BS Innovation Hub actually has a rich set of ongoing work.
That would be great indeed.
I see we have new questions.
There were questions about the cross-border aspect of CBDC, in particular, the choice between having a global ledger versus a kind of a country-specific ledger.
Oh, okay. Yeah, that's a good question. Let me, for a few minutes, share the screen and go to that section right away. Obviously, this is important, right? I mean, we have a pretty good wholesale payment system cross borders, but at the retail level, we have frictions. Sometimes, you send a small value payment, it takes forever, or it, actually doesn't reach the recipient because of inconsistency between the systems, and at very high fees. And in today's world, where you have cross-border e-commerce, where you have people traveling a lot, we have a lot of remittances. They're just different needs than they were in the 70s or 80s or 90s when these systems were designed. So there is scope for improvement, and there's a very simple notion why CBDCs could make a difference here. In today's system, cross-border transfers operate on the basis of the correspondent banking network. That means that typically not every bank in the world will have a relationship with every other bank in the world. A system will typically be set up that all the smaller banks in the world have a relationship with larger banks in their countries, who in turn have relationship with other large banks in other countries, who then have relationships with the receiving banks. And that is the chain of correspondent banking. And it's not only about information exchange, but also each payment has to work its way through the balance sheet of all these intermediaries, with the associated costs of pre-funding agreements, of having relationships, and so forth. And the notion here is that a CBDC could be a bit different, because it's a claim on one central bank that is exchanged on another central bank. Now, obviously, there's an FX market in between, and that FX market has to have liquidity by a private operator. So there are intermediaries that do something, but it's one transaction. It's not a chain of transfers between intermediaries. There might be a chain of communication, right? Because also communication might be aggregated, but that is much simpler because you do not need to pre-fund communication and so forth. So from a conceptual basis, there could be a lot to gain here. And we've sort of, again, right, at the BS, we always have sort of also the job to get an overview of everything, and we need to sort of start by thinking about potential arrangements and then later see what people actually do and put it in these buckets. And in another paper, sort of we've come up with sort of, we called this multi-CBDC arrangements, and we've thought about different ways of how this could work. And the first one is just enhanced compatibility. So you would have here, you would have two different systems. Each has its own infrastructure, its own rule book, and its own set of participants. And they are just constructed with an eye of increasing harmonization between these systems. So that makes it easier to set up the equivalent of the communication layer. But then there could be more, and that is the model 2 that interlinks. And the interlinked model, that you still have sort of the separate infrastructure, but sort of there is a higher degree of technical cooperation, and there is a technical interface that is jointly developed, right? So the systems are still separate, but the interfacing is done directly. And then when you have sort of a transaction, it's really processed through end to end via the use of this interface, and not via any sort of private sector rail that might be very heterogeneous and that you have to first build a relationship with. And the last one, and that relates to sort of the notion of this global ledger, is a single system, right? That's MCBDC model 3, MCBDC system. And that is actually where central banks get together. They do not form like a global currency, right? Those are different currencies. They're just connected. So the messaging of how all the transactions are exchanged are on a single system that the central banks have designed together. They've also agreed on a framework of how to jointly operate it, and they have a single set of participants. That means in practice, if jurisdiction A has sort of acknowledged this is a valid user in our system, then jurisdiction B would say, well, that user can transact in our joint system. So you would have the same set of participants. And obviously, you need to think about for these arrangements, you need to think about how difficult it is to engage in the compromise of building them and of operating them between jurisdictions. And more integration is more difficult to sustain. And the opposite is that obviously you will make cross-border transaction much simpler. And in the last one, actually, the cross-border transaction from a sort of computational environment is actually the same as a domestic transaction, because it goes through the same system. And the BIS Innovation Hub, and I'm just gonna close here, has a lot of activity in this setup. We have Project Girard, it's Banque de France with the Swiss Center. We have Project Dunbar, that is the BIS Innovation Hub in Singapore, so led by the MIS, with central banks Australia, Malaysia, Singapore, and South Africa. And we have a MCBDC bridge that is coming out of the Lion Rock model. That was originally Thailand and Hong Kong, but now there is many more. There's the United Arab Emirates and the People's Republic of China. And again, right, is this notion of developing joint interfaces. These three models that differ in sort of how they're set up, how the business models work there, and also how access is giving to the central bank access sheets. And there's really it's really about these nitty-gritty details. What are the steps of a transaction? How is that reflected in the central bank balance sheet on both sides? That really make a difference. And there's a lot of learning, and that's very exciting for me, moving over to the Innovation Hub to learn about these things in more depth. And I have more slides, but I just want to conclude here. I also want to thank everyone. I can actually stay for a few minutes if we have
that would be great. Indeed, we have quite a number of interesting questions coming in. Maybe let me post two of them, right? The first set of questions is about kind of the practical issues when we try to change kind of the incentive structure of holding CBDC. First one by Francesco is about, well, if we try to, implement some CBDC scheme with tiered incentives, right, either in terms of rate or quantity limit, how can it be carried out and how will that affect the uptake, right? And a related question is about the negative rate. If there's a negative rate imposed, how can it be, overcome some technical issues?
So yeah, so I think the question of uptake, right? That just features on anybody who's gone through all the thing. I know what it would solve. I know how it would design it, but will it be used? And I think sort of right, and the question of uptake is related to the sort of the overall issue of the systemic impact. So limiting the systemic impact, you can also induce some impact. Obviously, what the central bank can do easily is induce some loading up, right, by saying, look, I'm going to give a good interest rate on the first 1,000 euros or francs or whatever, or dollars that you deposit, and then people will start to hold some balances. Would they be using that? Would they then automatically start using that for payments? We actually don't know that, but it's a very important question. One connection I want to make is, and I think that's quite relevant, is as soon as you think about all these schemes where you tire the attractiveness by the holdings, then you are thinking about a fully identified system, right? And identified much more than today's commercial banking system is, because I need to worry about uniqueness, right? And in today's system, a bank only needs to check, is this a legitimate business? But it doesn't need to check, does this person have an account with a different bank, right? Maybe if you want a credit, that's the case, but not if you want to deposit money. They don't ask you that. But if you say, well, every citizen or every resident can hold 5,000 units of my currency unit at this favorable interest rate, then you need to sort of start uniquely identifying the users of that system, right? I mean, there are ways that can be done, but again, you need to be cognizant of the interrelationships between the economic and the privacy issues. And I think that's sort of something that I always want to get at in my work, and also in the BIS policy publications. It's there are these trade-offs there, and we can't have it all. We need to really zoom in on the use case and have one CBDC ecosystem designed for that use case, be that privacy, be that inclusion, or be that I feel a resilient backup payment system, right? You really need to think about these questions hard, and it's very good that central banks around the world are doing that.
That's right. And there's another very, I think, quite interesting question is about how the CBDC potentially can affect the architecture of the monetary and payment system, to the extent that maybe different types of FIs or fintechs, right, they may have benefit more or less, right, with the introduction of CBDC. Would it, for example, with the introduction of CBDC, making the banking system more narrow, if it bring more benefit to fintech, for example?
So yeah, I think that's a great question, right? And it's very closely related to this age-old discussion of whom should the central bank give access to the balance sheet. And here in Switzerland, for example, there is now this fintech banking license where you have fewer requirements to get it than for a real commercial bank, and you can deposit, I think, up to 100 million Swiss francs. And these are all these schemes where we sort of central banks are looking into the trade-off between giving access to tired access, and CBDC would naturally fit in that, because it would be a completely different form. You could say, well, I mean, I'm not giving this fintech access to the central balance sheet, but I'm allowing its retail users to deposit their CBDC with me, and then the fintech can do its auxiliary activity around that business that it gets. And it's interesting. I think it goes back to papers such as the one that you presented. How will we change the competition and how that will then affect the market structure and the outcome. And I think that could be, you know, if I don't want to make a prediction of what the exact impact would be of a CBDC, because I really think it depends on how you structure these access requirements and whether ultimately it's then big techs or smaller fintechs that come in, and how banks offer these systems in there, right? There's a lot of things we don't understand, but we understand things could move and could have quite some effects on the structure of competition in the industry.
That's great. And another question is about cross-border payment, kind of cross-border settlement design. The question is about whether or not kind of a DLT or blockchain-based technology could be used, maybe stablecoin could be used, and I suspect that behind the question is also about, you know, in a global system, maybe there's no global trust, and to what extent that maybe a blockchain-based technology would be desirable.
Yeah, yes, this is very interesting that sort of this distribution is used in a very different context in these MCBDC arrangements. It's more used in each national authority having control over its subnetwork, right? It's tiring of control, and you want to sort of be fully in control of your local loop, and the other central bank wants to be fully in control of its sub loop, and then you want to be jointly in control of sort of the crossing transactions. And that's exactly what these systems are doing or trying to do. We need to keep in mind, right? Those are early stage systems, proof of concepts, but it's exactly sort of, this is the flavor of decentralization, and often in these things it's about how you organize the structure of control between various central banks and various networks of commercial banks that reside in different jurisdictions.
Great. Now to conclude the session, maybe just let me ask one final question. So you mentioned at the beginning there's kind of the research and policy work are now not perfectly aligned right now. So for the audience, I know there are many students and researchers working on money, banking, and finance. Do you have any tips for them, right, in terms of what are the outstanding big questions that are challenging but promising topics that maybe would be useful for policymakers?
Yeah, so keep in mind that the space is moving very fast, and I've seen great papers recently that fill already many voids, but I think still generally the sort of the microeconomics of payment systems, banking, and how they interact with operational arrangements, I think that's very important. I think the international dimension, how various digital currencies interact with each other, how they will shape the international monetary system, it's very interesting. And then certainly I always think that, you know, privacy and how we could offer that, and what the role of central bank in the provision of this, that's for me very, very interesting. I'm working actually with computer scientists on that. So I'm actually not writing economics model, but we're really, you know, these are stuff that then is published in the association and the, you know, the ACM journals. But I think, you know, for me, that's where I feel that it's very interesting.
Thank you, Raphael. So I think it is time to conclude the session and thank our speaker. Let me also thank everyone for your participation. One thing the organizer asked me to bring up is that there's a conference, right, on Friday, May 13th, which has a virtual option. So want to encourage you to attend the meeting. I believe in the chat, there's also information that you can find in the chat box. So thank you everyone for coming to the session. Thank you, Raphael.
Thanks, Jonathan. And again, thanks, Will, and thanks, Fahad.
Yeah, thank you, Raphael, for the great presentation, and Jonathan for, you know, hosting the session. It's such an informative and insightful talk. I think everyone is learning a lot. So for the conference on May 13th, we do have people joining remotely as well. So Raphael, if you have time, definitely would love to see you there, and Jonathan as well.